Welcome back to the show. I'm John Knocklinger. I'm a men's divorce coach and a New Jersey divorce attorney and mediator. Today, we're going to talk about taxes. You may think that that's a dry topic, but let me tell you something. If you're going through a divorce or actually any major life change, you really need to be thinking about taxes. There's so many issues out there that are so important. And to help you learn a little bit about taxes today, we have an incredible guest, Hubert Johnson. He is a tax attorney, lecturer, and a former tax law professor. He's co-written 2 books, and he founded Guardian Tax Law in 2018. He's also the host of the TV show Taxes Made Easy on smartmoneyculture.tv. Thank you so much for being here today, Hubert.
Thank you for having me.
It's our pleasure. So before we get into taxes, one of the things I learned about you when we were just chatting was you have been divorced yourself. And even though that's a little off the topic that we're going to be talking about today, I do want to touch on that first because so many men that listen to this podcast are about to go through this process and they are scared and they have a lot of anxiety about what it's all going to mean for them. So can you tell our listeners a little bit about your divorce process and anything you learned throughout it, or any tips that you might want to give our listeners?
Yeah, it's brutal. I mean, I've had the pleasure of being divorced twice. The first time was due to a mental illness, and that was very severe. Second time, my wife decided to just go a different direction in life for me, and just didn't work out after that. Tried to make it for 2 years, and then finally it just didn't make sense anymore. But I actually ended up remarrying my first wife. The biggest advice I can give is get informed, take control of your finances, and work with experts to make sure that you're on top of things.
Well, and the guys that listen to this podcast are definitely getting informed. So that part of your advice is right on. And it's interestingly, I've seen a lot of people remarry spouses that they had previously divorced. It's actually not uncommon at all. It's a very interesting situation where maybe at one stage in your life, it wasn't a good fit, but then as you get older and become wiser and, have life experiences, all of a sudden maybe, and now it is a good fit. So that does happen. But I think your advice is so good. Just get information. Do not stick your head in the ground. That's the most important thing, right?
Yeah, if you stick your head in the ground, then you probably will need my services.
Absolutely. Well, so let's talk taxes. And I mean, taxes is one of those topics that people hate. I mean, they just hate it. They hate paying taxes. They hate filing tax returns. They hate getting that dreaded call from their CPA that they owe taxes. Just everyone hates taxes. But unfortunately, it's part of our lives. We have to deal with it. We have to deal with, our federal taxes. If you live in a state that's state taxes, then you have to deal with that too. And the most important thing is when you're going through a divorce, your tax situation is going to change. And so many of the things that happen in a divorce have an impact on taxes. So I just want to really just take you through a variety of things that people need to know that are going through divorce, and just sort of talk it out with you and get your input on what people need to know. And let's start with the one word that's like the biggest curse word in divorce for men, and that's alimony. I mean, you say alimony, and it's like nails on a chalkboard. Like guys just go, I can't deal with this. But it's really one of those things that you need to know how it interplays with taxes. So tell us a little bit about alimony and taxes.
Well, alimony kind of got lumped in with child support with TCJA, the Trump tax cuts back in 2017. I mean, it used to be that it was taxable to the receiver. So whoever is receiving the tax, the alimony or child support would pay the taxes on it. That got flipped for any divorce that was finalized post, I think, 2018. So for the last 6 years in a divorce, it's taxable to the payer. So you get to pay the alimony and the taxes on it. So when you're determining the alimony, keep that in mind, and as well as child support. Again, it's not a pretty picture. You can thank former President Trump for that as part of the tax reform, but that's just the way it's been, and there's not a lot of wiggle room there.
Yeah, my understanding is that was one of the ways they paid for the tax package, was to make sure people paying alimony don't get that deduction anymore.
Right.
And it used to be pretty good because the payment of alimony actually saved the family money. And so it was kind of an interesting little thing. But what about state taxes? Let's say you live in a state where you pay state income tax. Does alimony have any bearing on state income taxes?
Most of them follow the same federal guidelines, and because every state varies, again, there might be some variation there, but I'm not familiar with any variation. Again, we don't prepare taxes, so I would check with your local CPA or tax preparer.
Yeah, and actually that's good advice in general. Just remember, this is a general conversation we're having today, and you should go speak to somebody in your specific state for advice on your specific situation. This conversation is just meant to open your eyes as to all the issues that are out there. Now, when it comes to child support, obviously you just said child support's like alimony now, where you don't get any kind of child support has always been like this. You don't get any deduction for paying child support. But what about all of the other things that are related to child support? How do you deal with those in a divorce? Like things like your dependency deductions, your child tax credit, and all of those sorts of things.
So they really do follow whoever claims the child. So this is we see a lot of issues with this, where people make up all kinds of situations in who's going to claim the child. And you can do every other year. You can switch back and forth. It kind of raises havoc with your taxes. And so what we typically see is when people are switching year on, year off, if someone claims a child and it's not their year to claim them, or things change, the IRS is not going to get in between two couples. You try to argue of that. As long as one person, they both have custody, they both have parentage, they'll let them figure it out in court and family law court. So they'll have them go back and figure out, how child support figures. So if you have someone that you think is going to claim a child, it might just be easier to let them claim the child and pay less in child support, or receive more child support, especially if you think someone's going to claim a child that they shouldn't. It just makes it so much easier.
Is there anything special or any forms that have to be signed if you're like the custodial parent, you're going to let the other parent claim the taxes or claim the children?
No, the IRS is pretty easy about that, as long as you don't have more than one person claiming it. I did have an issue this year where I claimed one of my children. It was supposed to be my ex-wife actually switched which of my children she claimed, so had to figure that out. But I did a simple identity fraud issue on form that I filled out online because there was an issue. My ex claimed that she didn't claim the other child, and so it worked out that I was able to get my refund and get my tax returns processed. But when I filed them by paper, they got rejected. When I first tried electronically, then I did it by paper, they kept getting rejected. I did the identity theft affidavit online, and it was accepted. So if you have questions or you're having issues, just give us a quick call. That's pretty easy, just to steer you in the right direction there.
So that's what happens if, let's say, your ex claims a child and then you file your tax return claiming the same child, your tax return just gets rejected?
The first return will most likely be accepted. You can refile and do a paper filing. Now, if you have sole custody and you have court orders showing that you should be claiming the children, you can provide all of that to the IRS. It might take them a year or two to straighten it out, but then the ex could just do the same thing the next year. So if you have a problem ex-spouse that keeps claiming children that they're not supposed to, it's easier to go back to family law court and get them to pay more in support.
Yeah, and I will say that child support is calculated differently in every state, but there are a lot of states that have a guidelines calculation that takes into account who's claiming the children for that very reason, so that tangible benefit of what you're getting back from the government is spread equally between both the parents, even if one person's the one that's doing the claiming. I do find it very interesting at how that has changed so much, the child tax credit and how much money you get back. What is the current state of affairs when it comes to the child tax credit right now?
Depends who gets elected. So both parties are, and this is just like the tips, both parties are saying they're going to get rid of taxes on tips. Both parties, or both campaigns are saying that they're going to increase the child tax credit. How they're going to do that is a little bit fuzzy between the two parties. I believe the Harris campaign is offering a child tax credit that will be paid whether or not you were paying taxes. I think it's around $3,600. They want to increase it, and I'm a little fuzzy on the details because it's changed. But the Trump campaign came out and said they want to do $5,000, but not so it's a refundable credit. So only if you paid in taxes will you get that money back. So again, there's differences between the two proposals, but both parties want to increase the child tax credit. Again, it's an election year. There's all kinds of promises. What we'll actually get through Congress and not add too much to our budget deficit is another question altogether.
Yes, and you're listening to this or watching this. The election's already occurred. Probably you already know who the president's going to be. We're actually recording this podcast the day before the election, so that's why we're talking about what the campaigns are running. And yes, it is very funny. It's kind of like Oprah here. You get a tax cut. You get a tax cut. You get a tax cut. And then at some point, you're like, oh, well, we need to have money coming into the government from somewhere to run everything. It's going to be kind of interesting. But you did say something that I think is a very important concept that people need to know when they're going through a divorce. And that is this whole idea of refundable versus non-refundable tax credits. And the reason I would like you to expand upon this a little bit is this is actually a tangible thing that you need to think about when you're putting together a divorce agreement, because you may have a situation where you're agreeing that your ex, soon to be ex, is going to be able to claim the children. But what if they don't have income? So talk to me a little bit about refundable versus non-refundable tax credits.
So basically, if it's refundable, you get the tax credit regardless if you actually pay taxes in. So it's just free money from the government, regardless of if you paid in or not. It's to help child poverty. I believe that's from the Harris campaign, focusing on getting money out there to poor and indigent families across the board. The Republican proposal, I believe, is non-refundable. So it's only if you've paid in that much, then you get the money back. So if you don't have income, and if your ex has less income and she hasn't paid that much in taxes, it makes more sense for the party with greater income to claim the children, get that refund, and then compensate that through child support or alimony.
Yeah, I think that's great, and we'll call that a pro tip, and that's that if it's a non-refundable tax credit, you need to make sure that whoever's claiming it can actually claim the entire amount, and if they can't, you should think about inserting some kind of provision in your agreement so that the other person can then claim the tax credit that year. Because you have to think about it as this is money for your kids, and it's there for everybody in the country. So you want to make sure that your family gets the entire amount if you can. And most of you will have an attorney helping you, but most attorneys are, let's just say, not that great when it comes to issues like this. So it's important for you, anyone listening to this podcast, make sure you write that down as an issue, because claiming your kids on your tax returns is something that absolutely should be addressed in your settlement agreement, and absolutely you should address it in a way where your family gets as much money as possible back from the government. So just really keep that in mind as you go forward. Let's talk about the tax filing status, because I know a lot of people get confused. And I want you to address this in a couple different ways. The first thing is, when do you get to change your filing status from married to something else? And then secondly, which, you're now divorced, and maybe you've got joint custody of children. What do you do? Is it single, head of household? What are the differences? Tell us a little bit.
So you can change your status, your filing status, pretty much any time. And there are plenty of people that I recommend, if they're having issues with their spouse, either going towards divorce or not, if you don't trust them when it comes to taxes and finances, or if they have a business and they've been owing taxes, you can absolutely do married filing single whilst you're still married. If you do married filing joint, the IRS pursues it as joint and several liability, which means they'll go after both parties. Doesn't matter who's the guilty one. And this is more typical for women, but you have stay-at-home moms that have been taking care of the kids, husband's working. She might not even know about the taxes being owed and will still be held responsible if she signs on, because the IRS treats it as income that benefited the home, even if the taxes weren't being paid, which benefited the home and the income to the home. So a lot of people throw out innocent spouse relief. And so if your partner has a lot of money and they're not paying taxes, or that innocent spouse really is for people that had no idea the spouse kept the money hidden, didn't inform them about that. And I'm kind of going off on a tangent here, but it's much harder to get than people think. So a lot of people are saying, oh, just apply for innocent spouse. Not so easy. So if you have concerns and you want to stay married, do married filing separate. If they owe a bunch of taxes and you don't, the only thing to watch out for is if you're in a community property state, back west mostly, your assets can still, 50% of your assets can still be attached, any community property assets, by IRS or state collection agencies if you're in a community property state.
No, that's good to know. This whole innocent spouse thing is, I hear it come up all the time. People will Google that and they'll be like, oh, well, I'll just file this innocent spouse thing and I won't have to pay any taxes. But you're right. My understanding too is it's always been very difficult to get, because if you're sitting there, living in the $2 million house, and your husband is showing, $100,000 on their tax return, and all this cash is sitting everywhere and not being paid on, you really can't say you didn't know. You knew,
And it's not even extreme examples like that. It's just, someone has a regular job and they're not paying 10, 20,000. If you sign on that bottom line, this is why one of my biggest pieces of advice starting out is, if you aren't the one dealing with the CPA, if you're not the one handling the finances, you need to get informed. If you're struggling with your marriage or think divorce might be an option, and as a tax attorney, I'm going to say you should know anyway. Don't just sign on it. If you have a CPA that's buddy with your partner, you might want to get a second opinion before you sign on the bottom line, especially if you have a business Schedule C, if they have something else going on and you don't understand it, someone should be able to explain it to you. You shouldn't be signing on blindly, because that signing on, even if it's an electronic signature, obligates you to pay the taxes on those returns, except for in rare circumstances. And the rare circumstance, I had a relative who he was a trucker driving on the road all the time, and his wife was embezzling money. The money went to separate accounts that he never saw, he never touched. He wasn't home a lot, so he didn't see a lot of the money flowing and what was happening. And she actually went to prison, as well as their son, because she involved him. He came home, the raids, this information LBCs, but he didn't have a clue and didn't have a reason to know, because she used separate accounts.
Wow.
That was a clear case of innocent spouse. So pretty extreme.
Yeah, well, so it sounds like it has to be fairly extreme to get it. Let's talk about, once you start going through a divorce, when can you file single or head of household as opposed to married filing separately? So
the year of the divorce. You get to choose at the year of the divorce. You can choose to file singly, or a lot of people choose head of household. I would be careful with that. A lot of people choose that erroneously. Usually it's just single. Again, that's more of a CPA question. That's not something that we deal with, but again, you have to look at the details of it. Usually head of household is where you have one person filing married, filing single, and the other person is claiming head of household and the children. So again, that's outside of my realm of expertise, but make sure you're talking to a CPA, or a tax preparer, and choosing that election correctly, because I've seen plenty of people choose head of household when they shouldn't have, and it comes back to bite them, when they're actually single and living separately.
So if you get divorced, let's say September 1st of this year, you get to file for 2024, you get to file single if you want at that point. Mm-hmm. Is that right?
Now, tax-wise, the most advantageous way to file is always married filing joint. But if there's any issues and you file married filing joint, you're stuck with them. So it's very hard to go back. Now, one thing I do see is where you get people that haven't filed tax returns for many years, and you're trying to get straight and clear up your tax situation. If you had a partner that wasn't straight on their taxes, wasn't dealing with things they should have been, there's absolutely no reason to go backwards and file married filing joint with them, even if you were married. I would do married filing single. You get hit harder on your taxes, but it absolutely pays not to get stuck with their tax issues, and you can avoid a whole mess there.
Yeah, whenever you're doing your divorce settlement, make sure that there's language that protects you about past tax returns and who's responsible for what. That's something I see missed a lot in agreements.
It's in agreements, and if you can do that, but you know how much the IRS cares about what's in an MSA or a settlement agreement?
Oh yeah, they don't care. I mean, you're still going to be personally liable, but at least you'd have a basis to go after your ex's assets and that sort of thing. Yeah, I mean, that's the problem. The IRS doesn't care what's in your settlement agreement, but you have to protect yourself as much as possible. And I see people that don't do that all the time. And that actually goes back to what we were talking about a second ago, which is claiming the kids. The IRS, you reference sending the IRS a copy of the agreement. And here's what I was supposed to be able to claim the kids, but that could take years. It's the same thing in the short term. The second tax return doesn't get accepted, and you're left with either having to go through an arduous process with the IRS or go back to court and hold your ex-spouse, in contempt of the divorce agreement. Either way, the IRS they just want their money. They just want their money. They don't care about you and your ex and what kind of agreements you guys had.
Yeah, they will respect most property divisions as long as they're reasonable. But as far as who's supposed to pay what, that's why if you have an ex that you think is going to be a problem, or you suspect that they might claim kids that they're not supposed to, that's why I suggest sometimes it's just easier. Let them claim them, pay less in child support or alimony, or get other assets from the marriage and compensation. That way you're avoiding problems moving forward.
Yeah, I remember way back in law school, more than 20 years ago, I took tax. And I remember like that whole analysis of property division versus alimony, and how the IRS is really suspicious of payments and making sure that you're not trying to get a tax. Back in the days when you could get a tax deduction, trying to get a tax deduction for actually division of assets as opposed to alimony, and how complicated that used to be. But now we don't have to deal with that anymore because alimony is not tax deductible anymore.
Yeah.
Suffice to say, it was not my favorite class in the world. Not to take anything away from you, but oh my, taxes are difficult. It's very, very, very complicated.
Here's something funny. I hated that class too, and then I ended up teaching it. I tried to make it more interesting when I taught it, but I was teaching graduate accounting students, and 2 + 2 doesn't always equal 4 in the law, and it drove them batty. So
I'm sure it did. Sure it did. No doubt. Well, strangely enough, I took family law classes in law school, and I hated all of them, and I became a family law attorney. So I guess when we're in school, you can't really tell where things are going to be heading. So, talk to me about deductions for things like mortgage interest, property taxes, and that sort of thing. That you might want to make sure allocated in a settlement agreement. Is this also a situation where the IRS doesn't really care what the agreement was, and you have to, if someone doesn't claim it correctly, you'd have to go back to family court? Or does the IRS, will they help you enforce an agreement?
No, they don't have the capacity to help enforce the agreement. Um, Usually when you're divorcing, as long as the numbers add up, but it makes more sense just to have the person with more income claim the deductions, get the tax break, and then offset it. So again, when you're selling a home, it's always a little messy the year that you sell it. But splitting deductions, stuff like that, as long as the total amount is fine, but you have computer programs running through and reviewing all these tax returns. And then if there's an issue, someone might glance at it, but to get someone to actually look at it, you have to usually paper file it if it doesn't go through the computer system, and then it's taking years longer to do it. So all about the easier you make it for the IRS, the fewer problems you're going to have for them. So again, I would just keep it simple, and again, sit down, work with your CPA to see what they suggest. If someone claims one deduction where someone else claims another one, and you try to offset it that way. But again, as far as claiming mortgage interest, that's more of a CPA question, but I would just keep it simple with the IRS, and you'll avoid more problems and avoid audits, because when you don't have paperwork, the IRS is coming out through and auditing people more than ever. And some of the audits are more extreme than ever. They do line by line audits, which they've always done, but they've increased the frequency of that, where they go through every single line on your tax return. They don't have any reason to be suspicious of most of them, but they will scrutinize every single line on your tax return. So make sure you have that proof. Make sure you have those receipts. And if you're claiming part of the deduction and sharing that with someone else, it just gets it's a red flag that can cause or lead to an audit.
And how long do you need to keep everything that's related to a tax return in case of an audit?
Typically 5 years, 5 to 6 years. I have seen things pop up, though, much older than that, believe it or not. People file their returns. They think they get processed. This applies to the state as well as the IRS. They are very good at losing things. So I've had people that filed returns that they thought had been filed 5, 10 years down the road, and the IRS stops pursuing returns after 6 years. The states can go back 10, 15 years or more. So especially in a digital world, there's no reason not to digitize that, put it in a cloud or some kind of safe digital file, and just leave it there. It's not going to hurt you. It's not going to fill up, reams and reams of paperwork. But one of the biggest issues I see is people don't get a copy from their CPA, their tax preparer, especially if one person is always doing it, the other person is out in the dark, and they don't have a clue what's been going on. Get those records, especially going back if you can. Maintain them moving forward. It's so easy to scan things in and digitize them. Keep those records, I would say, at least 10 to 15 years, because you never know when a state issue might pop up that goes back much further than you would ever believe.
So when it comes to the federal government, is there a statute of limitations of how far they can go back?
They can go back and audit 6 years.
Okay.
So if you're approaching that 6-year mark, they're really not going to audit further back than that. But I've seen cases where people assume, especially if you're not the one filing returns, they thought tax returns were filed. And it's also 6 years for them to do what's called a substitute for return, where they file for you in the worst way possible. Those limitations don't apply to the states, though.
Yikes.
So they can go back further, and it can be pretty messy. And that's where I see a lot of people get in trouble with not having documents going back. But typically, it's because they didn't get the information from the CPA, their partner has everything, and they don't have access to anything. And that's where it becomes a lot tougher for someone to get that information. Now, if you have straight W-2 information, the IRS, and you can usually get that information from the states for what was reported to them. But if you have deductions, if you have exemptions, stuff like that, they're not going to have that information. So you can get 1099 W-2 information, any kind of payments that was reported to the IRS. They have that on your IRS transcripts, and you can get those 10 years back.
Yeah, most people don't realize that you can just go on the IRS website and get your tax transcripts. I see people all the time that they're like, well, I don't have my tax return. I'm like, well, just go get your transcript, so at least we know what was in your return. A lot of people just don't even know that you can go do that.
And it varies. So for you referenced a tax return transcript, they only keep those for 3 years. But the IRS. But you can get the wage and income transcripts going back 10 years, and the account transcripts, which is the bills and credits and debits on your account, and essentially what happened on your tax account, you can get that as far back as you have any kind of information on your tax returns. I believe they go back 15, 20 years on that.
That's interesting.
But as far as your tax returns, what was actually on your tax return, it's only the last 3 years.
Interesting. All right. Well, that's good to know. Well, then let's talk about some practical advice then. So you're going through a divorce and, you're negotiating issues with regard to your taxes. Let's say that you know that there's taxes that are owed. I guess the first question I have is, does the IRS really go after only one person for the taxes, or do they equally go after both people? And depending on your answer to that, how would you recommend somebody structure an agreement to ensure that that tax liability does get paid the way you intended for it to be paid, whether it's 50-50 or some other kind of arrangement?
50-50 is horrible. Absolutely horrible. And the reason is the IRS can go after both parties. If your social is a tax return for that tax year, they can go after both parties. And typically you have some joint debt, and then one person starts filing married, filing single because they know there's issues, or they learned that there's issues going into a situation or a divorce. The IRS can go after both parties. Should they go after both parties equally? Sure, but don't hold your breath. And it's all confidential, so they will not reveal to one party or the other what's happening with the other party. We do represent divorcing partners as long as there's not a conflict of interest. We have a case right now where there's a conflict of interest has arisen. One person wants to do an offer in compromise and settle their debt, but that leaves the other person holding the bag, and they're paying on an installment agreement. So one person wants to settle theirs for $20 and leave the other person with holding the bag and paying the installment agreement on the full amount. So what one person might qualify for might really leave the other person holding the bag, and that's within their rights to go and do an offer in compromise. So if you're the responsible party, you have the income, you're the one that's paying the taxes, my advice to them is don't trust your partner as far as you can throw them. And I'm not trying to create more division here, but I've had cases where someone said, I want to do the right thing. I want to set up an installment agreement and include my former partner. Just a quick note on that. If someone goes and sets up an installment agreement or a resolution under their social, it only protects that social. The IRS can go after the other social for the full amount, which we see all the time. So when we're representing both parties, we try to set up a resolution under both socials. We can do that and protect both parties. That works in the short term. And the long term, unless the debt is paid off, we typically, someone loses a job, something happens, and it usually leaves one person holding the bag. So to counteract that, if you're the responsible party, it can make a lot more sense to assume responsibility for the whole debt, get other assets to compensate you from the division of marital property, so that way you're made whole. And then if something happens with you and life changes or whatever, you have assets to address it. But especially if the other person is not very responsible, or their job situation has fluctuated, you're not going to be left holding the bag and having to pay for the whole amount. It can get fun.
That's smart. No, I think that's excellent advice. Actually, I think that advice would apply to any joint obligation, joint liability. I mean, we don't have a lot of truly joint credit cards anymore. People usually have them in their own name, with the other one being authorized. But if you have a joint loan or anything, always keep that in mind. I mean, someone could file for bankruptcy after the divorce, and you're left holding the bag for the entire amount. So it's important. I think that's a good bit of advice anyway. And I actually, as a divorce attorney, I tell people all the time, don't ever divide debt 50-50 on a payment forward going basis. Always assume debts, and then just make sure that the division of the assets makes sense within the context of you assuming certain debts, because you don't want to rely upon this person you're not married to anymore to make payments post-divorce. I think that's super great advice for everybody.
And you're an exception as a divorce attorney to do that. I can't tell you how many settlement agreements have that exact 50-50 language. They'll both pay the payments equally, and then they're upset when the other person doesn't pay. I'm like, that was a horrible arrangement.
Oh, it's horrible. I've seen it before where people will say things like each party's going to pay 50% of the minimum payment on the credit card or some other nonsense like that. You're like, how's that even going to work? I just assume debts when you're going through a divorce. Just assume debts and get yourself compensated some other way. I mean, it's not just assets. I mean, you could get compensated through a reduction, perhaps a alimony obligation or some other mechanism to sort of make it work. There's creativity is what good divorce attorneys and good tax attorneys do. It's all about being creative within this lovely law that we have to live under.
And being creative, one thing we definitely use, it's not in our toolkit because we don't do bankruptcies, but it is an option. And tax debt that's older than 2 years typically can be discharged in bankruptcy. The only issue is if you have newer tax debt within the last couple of years, or if you have older tax debt that hasn't been filed, they go off the date of assessment. So if you're filing 5 years to get current, that 2 year is starting at that moment. So a lot of times someone will file for bankruptcy and then we'll deal with the remaining tax issues afterwards. But if one spouse is filing for bankruptcy and not the other, you might have this arrangement and again be left holding the bag if the other person files for bankruptcy.
Yeah, and I mean, we're talking about taxes on this podcast, but bankruptcy is a whole nother issue altogether. And much like issues with taxes, you need to make sure your settlement agreement when you're going through a divorce addresses bankruptcy as well, because I see that left out of a lot of agreements. And the absence of it, if somebody post-divorce files for bankruptcy and it upsets the way in which things were supposed to occur, it can create a very bad situation for the other person. I mean, the examples of this are too numerous to go into, but just be sure your agreement addresses that the intention is that everything in this agreement will be maintained the way that it says in the agreement, even if someone files for bankruptcy. And again, they may get relief, they may get debts canceled, maybe tax obligations get canceled, whatever the case may be, but you got to provide yourself a way to be able to go back into court and at least get a family court judge to compel maybe your ex to pay you money to compensate you for what they just went through in bankruptcy. It's something that I don't see in every divorce agreement, and it makes me cringe because, I always like to say the absence of something in an agreement kind of means that you guys didn't want to address it. And that's not always the case. A lot of times it's just because attorneys are lazy or they just don't know to address things. Have you had any experience like with anyone who's been divorced where someone files for bankruptcy and, even in the context of taxes, it just really screws up what they intended their agreement to be?
A lot. Bankruptcy, filing for bankruptcy, doing an offer. It happens all the time where one person goes and files for bankruptcy and the other person is left still responsible for the debt.
Yeah, holding the bag.
Yeah.
And I'm sure it's like this in most jurisdictions, but usually filing for bankruptcy also will stay the divorce proceedings, and stay just means freeze them, which is insane. And we see people use it as sort of like a little offensive weapon in divorce sometimes. Is they'll just file for bankruptcy, and it really makes the court not be able to do anything until the bankruptcy is resolved. Bankruptcy is a whole different issue, though. We could talk about that all day. I wanted to ask you about name changes. Now, our audience is mostly men, but I will tell you, I'm seeing a increase in guys getting married and doing all kinds of hyphenated last names and that sort of thing. It's a different world we're living in now, right? Everyone's sort of doing things differently. But regardless of the fact, when you get divorced, usually you have the right to change your name. And quite frankly, I think this is the law of most states. You can change your name to just about anything, which is strange. You would think you could only change it back to whatever you had before you got married, but that's not always the case. So let's assume that you change your name. What does that mean for you in terms of your, social security number and all your other identification things? What are the things that our listeners need to know about what you need to do to make sure that you changing your name doesn't have negative consequences for you?
Well, it can. And we see it, especially if someone's gone through multiple relationships, multiple marriages. When you're dealing, first of all, if you don't change it with the Social Security Department, it's not a real name change. I mean, you can call yourself whatever you want, but the IRS is going to go off what's with the Social Security Department, and they're really going to go off your last tax return. So it can be difficult if you haven't filed a tax return for a few years and you've had some name changes. We just have to make sure that it matches what's on the Social Security card and that it matches what's on the tax return. So they'll just go, they don't really care about name changes as long as they can confirm the identity. This is what their name used to be. This is their current name. And as long as there's some kind of continuity. But I've had somebody go through multiple name changes. And when we're verifying our identity and that we're representing the right person, it can be a challenge sometime if someone has multiple last names, multiple first names, and especially if those have changed due to marriage and divorce.
Procedurally, what do you do? I mean, you get an order from a divorce judge saying you have the right to change your name to, whatever. How do you actually go about doing that?
Well, you go to the Social Security Administration and actually do the official name change. Once that happens, then you can go and take that, because you have to verify your identity to file taxes. Any tax preparer should be checking a driver's license, et cetera, that you are who you are, saying that you actually belong to that Social Security number. And then once you file your tax returns, it will update it in the IRS system. So I've seen someone that had a different name for 4 or 5 different tax returns. I don't recommend that unless you just want to pay divorce attorneys a lot of money. But as long as we have all those names as your tax attorney, there's times I'm going like, what about this name? What about this name? Oh, okay, finally, that's the one that matches. And it matters if there's a junior or senior or a third behind their name. They really do want the full name. So that's when I talk to people. I'm like, what is your full name on your tax return? If you have other names that you've used in the past, just go ahead and give them all to me. And as long as I have that, there's times I call the IRS, and it's not as big of an issue as you would think it is with identity theft today. But I might be on the phone with the IRS, say, well, let me give them a quick call. I'll call the client. Sometimes just conference them into the call. What other names have you had? And as long as they can give me the correct name, I can usually get through past their authentication and help them out. But you mentioned one thing earlier that I do want to address here, and this goes with identity theft, which is really big. And I see not so much with divorcing spouses. I mean, it does happen, but especially if failed relationships, identity theft. So you mentioned getting an irs.gov account to access your transcripts. It can be very helpful. The IRS is putting a lot of effort and time and money into developing irs.gov. You should set up a PIN to file your tax returns. And I saw your eyes get big. The best preparers out there are having all their clients do this. It will protect your identity. It will make sure that when you're filing your tax returns, nobody else can mess with that or file a return without that PIN. So it can save you in so many ways, especially if you have a spouse that might try to steal your identity, which does happen.
Yeah, it does happen. These aggrieved ex-spouses do all kinds of crazy stuff. And they know a lot about you. They know all your personal information, so they can do it. So we've gone through a bunch of information about taxes. I think the most important thing that you should glean from all this is if you're going through a divorce, you need to talk to a tax professional. A CPA, somebody who can help you understand, what kind of tax return should you be filing? Should you be getting divorced on a certain date versus another date? How you should be dealing with all the deductions and exemptions and everything that we've been talking about. But if you owe taxes, you're having issues with past taxes, like we were talking about, like the spouse that's been doing some inappropriate, been very naughty during the marriage and you're finding out about it during the divorce, or if you have a lot of debt and you don't know how to deal with it, I think they need to come to somebody like you to make sure that they're addressing it. So can you tell our listeners a little bit about what it is that, what it is you do in your firm and the types of services you offer that would help people going through a divorce?
And I just want to add something, that we don't prepare returns, but we work with excellent CPAs and tax preparers across the country. So just in the last month, I referred people to LA, Chicago. I just spoke to a CPA in Chicago, New Hampshire. We have CPAs we use in Florida, New York, all across the country. We work with a network of CPAs and we will vet them. And most CPAs will handle taxes in multiple states. So if you don't feel like you have a good CPA, I mean, there's no cost. We don't get any fees from this. We can refer you to someone that can help answer your questions, make sure that you can get informed. We also do a free consultation. If you have a letter or just a quick question, we answer those all day long. Again, we run our company a little differently, where we don't feel like you should have to pay an arm and a leg just to get some free tax advice. And we love helping people avoid bear traps. We really help when you owe taxes to state and federal, business or personal. But if you're not sure, I mean, we also deal with other thorny issues. We had a guy that couldn't get his tax return filed for or processed by the IRS for over 3 years, and he's waiting for a refund for more than 3 years, and it was a sizable refund. We know how to get through to the right people and get it taken care of and resolve some very thorny issues like that. So if you have a question, just give us a call. If we don't do it, we know who does, and we can refer you on to make sure that we can give you that peace of mind and steer you in the right direction.
All right. And beyond taxes, you also help people with just other debts?
There's a few other areas that we work with. Mainly, we're seeing a lot of SBA cases where people have EIDL loans. So if you have a business that's struggling to stay on top of those payments for EIDL, SBA loans, we do assist with those. They do have very similar programs to the IRS. And if you have foreign assets, we help with that, FBAR cases, FinCEN cases like that.
Nice. All right. Well, if someone wants to take advantage of this free consultation with you, how do they reach you?
520-485-7371. And you can also reach out to us through our website at guardiantaxlaw.com. And we have plenty of content there that you can just scroll through. We have a YouTube channel where you can go through and peruse the TV shows that I've done as well. And we have lots of topics that have been covered.
Awesome. I'm sure all the things we talked about today, you probably have a whole show where you went into a lot of depth on each and every one. So I encourage everyone to go watch those and consume your content. Your website's excellent. I took some time to look through it earlier, and that's saying something, because there's a lot of people that have very poor websites, and yours provides a lot of information, and that's always great. Well, I really appreciate you being here today. I know I learned several very new things that I didn't know, and I hope everyone that was listening today also learned something.
Well, thank you. I learned as well.